Hello, Ken Himmler here, and I wanted to reach out to you because I just had an experience today that I thought would be very informative for you and would help you on understanding some of the things that are happening with Secure Act 2.0. So let me kind of give you the premise to the story here. So we had a client email in, and they had a large amount that they have saved into 529s for their kids. And the question was, do we continue to use the 529 to pay for the kids' college? And we said under Secure Act 2.0, because for some of you, you know that we're going to be doing a webinar on March 1st on Secure Act, but these were questions that came up before we had a chance to really communicate these changes to them. So let me explain. Secure Act 2.0 was passed and it is in place now. Secure Act 1.0 was passed in March, I think it was, of 2020. This is where they upended all of the trust changes. The RMDs came into place. It was a lot of changes. And I'm going to focus today on just the 529s, nothing more, and so that you can understand it. So let's go through that real quick. A 529 is a program that you can put money away. You can put in a certain amount depending upon the state, and you can even advanced fund it. The advanced funding allows you to remove those funds from your estate, and you have two different types of registrations. You have the account grantor, not the technical term, but maybe it'll make sense. A grantor is I open up a 529 for my daughter. I put in 50 grand. I'm the grantor of that account. It's technically called the account registrate. And then I have a beneficiary. Now my daughter's the beneficiary. Now, the beauty of a 529 is it breaks almost all rules of gifting, estate tax, all kinds of things. First, 529s have gone through a lot of iterations. They've been around for about 20 years, and you could pay for a lot of things now that you couldn't pay for with a 529 in the past. You could pay for a non-college education. You could pay for room book. There's all kinds of stuff. Anyway, the goal of the 529 is it can immediately be removed from your estate, number one. And number two is a 529 is asset protected. So once I give that money, it can never be attached in a lawsuit. The IRS cannot get to it. It's kind of out there in the ether, that no one can get to it because there's really not an owner. I am the contributor, and then the child, if it doesn't have to be a child, it could be anybody, they are the beneficiaries. Now here's where it gets really interesting. The money grows without tax. I'm not going to say it's tax-free because that would get confusing. It grows without tax inside the 529. If you used it for qualified expenses, and again, those qualified expenses change year to year, but they have expanded greatly, then you can take the money out without any penalty at all, without any tax at all. Now, if you do take money out and it's not for a qualified expense, then you pay 10%. Now, here's the catch, and this is what most people don't understand. And they always confuse this on Roths too. You only pay the 10% penalty on the gain, not the entire amount. The other advantage, again, not only just the asset protection, but it removes it from estate tax. And you can 5-year forward gift. Now, the only catch with that is if you die in between the full 5 years, they recapture some of what you have forward gifted. But again, that goes against all tax logic, all asset protection logic. Okay, so now let's get to the point of the new Secure Act 2.0 and the new strategy that we are not only teaching but implementing with all of our clients. So when you have this pot of money, if you have estate taxes that might be due on this non-pot of money, so you got to visualize this. So here's your 529 in this pot, and then there's all the other assets in this pot. Now, see, this pot is still subjected to estate tax. It's still subjected to income tax on a yearly basis when the dividends get paid out. It's subjected to lawsuits. So this is the pot that's unprotected. This is the protected pot. Now, if you think through and I'll explain Secure Act, if I'm going to spend money on children's education, do I want to spend it out of the protected pot or the non-protected pot? I want to spend it out of the non-protected pot. Now, I will give you a situation. You have 529, and that's what you've saved for your kids' education. You have no other money. There's no other assets. Yes, well, of course, you're going to use the 529, But I'm talking about these two pots of money that you have the option of which one to choose from. And if you have the 529 in a protected pot, you do not, let me clarify this, you do not want to spend that money on the college education. You want to spend down the other money. Now, how might you do this? Well, let's say that you have a stock, an appreciated stock. And in this client's particular situation, they have two kids, and they have a lot of appreciated stock that is outside of the 529. So what do? You can do two different things. One is if it's a qualified expense, such as tuition. Remember, you can gift money to a college, and that is not a taxable event. So if you have appreciated stock, you could gift that to the college, and the college could sell it. Second thing is you could gift it to a child. And most likely, that child is going to be in a much lower tax bracket as you are. Now remember, depending upon what state you live in and depending upon what the basis is on the stock, you can gift, assuming the child has no other income, because that has to be a calculation, but the child can earn up to almost $70,000 on capital gains, and it can be tax-free. And even if there are other circumstances, it might only be 10% tax. So again, if I have these two pots, and this is my protected pot right here, this is my 529, and yes, I could use that for college, but remember, I still have estate taxes due over here. Somebody could still get to this through lawsuit. The IRS could still get to this. And honestly, there's still taxes that are due on income on this. So I want to use this unprotected pot. Now, Secure Act 2.0. What has changed? Well, now with, and I'm going to go off a tangent a little bit here, but there's also something called a healthcare savings account, an HSA. We are now telling clients, do not spend the money you have saved in an HSA for healthcare. Don't do it. Because now under Secure Act 2.0, you can convert that to an IRA. So you don't want to spend it down. It's spending down a good asset. Spend down bad assets. Assets that still can get taxed, assets that the IRS can get to, assets that can be gotten in a lawsuit. Spend those down first. Leave those protected assets. Same thing with the 529. We're advocating that if you have other funds, do not spend down the 529. Here's another really cool thing about the Secure Act 2.0. They will now allow you to convert $6,500 per year from the 529 to a Roth, but the Roth has to be in the beneficiary's name. So let's use an example. You got $300,000 sitting inside of a 529, and you have it. We'll just use one child. You could convert $6,500 a year until you get to the maximum of $35,000. So if I have $300,000 here, I could convert down $35,000 to a child's Roth. What's the advantage of the Roth? Zero tax. As long as you leave the gain in the Roth for at least 5 years, 100% is tax-free. It's a no-brainer. It's not even a loophole. It's a greased slide, like a playground slide, to a better outcome. This is, again, just an absolute no-brainer. So you want to convert as much as you can into the child's Roth. Now, what do you do with the excess? If you have other funds to pay for the college education, what do you do with the excess? Well, there's a couple things you can do. One is leave that same child as the beneficiary of the 529. There's no required minimum distributions like there is on an IRA. And upon death, it then passes to that child as the new account holder and the beneficiary. Now, what your child can do is they can rename the beneficiary to a grandchild, and they can use that money for their college education if it makes sense at that time. Here's the other advantage that you can do on a 529. You can change the beneficiary back to yourself if you wanted to, meaning you have this $300,000 sitting inside of a 529, and you initially had your child as the beneficiary, but you can change the beneficiary to whomever you want. But you don't want to do that until after the Roth has been completed, because you can only convert to the Roth as to the currently named beneficiary. Now, once you've done that, if you want to convert that beneficiary back to yourself, you can do that. Now, what's the only downside to it, if it is even a downside? If you do not use it for a qualified educational expense, qualified under the list that the IRS publishes annually, you pay the tax on the gain plus a 10% penalty. That's not a bad thing. That is not a bad thing at all. You might say, well, that's 10%, right? It's 10% of the gain only. And here's the great thing about it. Unlike an IRA, there's no RMD. So what you can do is you can throttle the amount coming in or coming out of the 529 so that it can actually be within the lower tax bracket. And so I would submit, and because I'm doing this for myself, if you had the option of paying the tax plus the 10% by changing the beneficiary back to yourself, that is a great asset protection vehicle because A, it's out of your estate. B, it's out of the IRS's grasp. C, it's out of lawsuit potential. So again, what I'm clarifying with you is do not use the 529 to pay for college expenses if you have other resources to do it. There's other, under Secure Act 2.0, there's many other advantages to paying it with outside funds. All right, I won't belabor the point. I'm going to try to do some other, as I get these questions until we do our webinar on Secure Act 2.0, I'll try to shoot some videos out to you so that you have some understanding of what to do in the meantime. All right, thanks for joining.